Hey there, welcome to Nebi Invest. So, February reporting season is almost at a completion. We'll see some stragglers release their financial reports before the open on Monday, but if they don't release it before that time, they will be automatically suspended by the ASX. Now, in this video, I'll be looking at 5 companies whose share price has been punished by the market because more than likely their financial reports either didn't meet market expectations or they have released some sort of outlook which is quite bearish. So, wide range of companies here. We are looking at 2 IPOs. Now, I do have a bit of a strategy where I don't buy into IPOs initially. I do wait for a little bit of time, and typically what I wait for is some sort of sign from the company that they are exceeding expectations, particularly in regards to their prospectus forecasts. I'm also going to be looking at another company which I am quite bullish about in the long term, but the share price can be quite volatile, particularly if the directors sell some shares. And another company where if you did take a clue from the market, you might have sold out a few months ago because it went into a fairly significant downtrend about 1 or 2 months ago, and that was a signal to sell. Another company I've never talked about before, so this is the first time I've looked at this mining, construction, engineering services company. So let's get into the first company, which is, and that is Nuix, ticker code NXL, a recent IPO. There is a lot of interest in this company. I've had a few requests to do a video on Nuix. Now, their share price down 32% on Friday when they released their report. Now, that's sort of a double hit because not only did you have the market go down by over 2%, you also had a negative financial report released from the company. So 32% down, but it still is above their IPO price, which, if I remember correctly, was $5, and it opened quite a bit higher when they did their first day of trading. So you can see it traded up to $8, has been as high as almost $12. So it's almost halved in price since those highs in middle to late January. Now, market cap of $2 billion, so I have had a quick look at this company, and the first thing that threw me off Nuix was the valuation. Market cap of $1.9 billion. They do revenue, or they're expecting revenue of around $200 million for the financial year, and for this half year it was only $85 million, and operating cash flow for the half year only $16 million. So when you look at some of the valuation metrics, price to operating cash flow, that sort of thing, the valuation for this company is quite rich. And right now the tech sector is undergoing some headwinds, particularly with the bond yields rising, and bond yields rising is the #1 enemy for tech companies. A little snippet from from their presentation is the annual contract value, and it's actually going down. So, in actual fact, when I did look at some of their financial numbers, there was a lot of downs. In fact, I think it was revenue is down 4% year on year. And that's one thing I don't like to see, particularly for a company that is highly valued, to see their revenue go down. Now, they have confirmed or reaffirmed guidance for the financial year or their prospectus. That's one good thing, but I think the market is now saying they don't believe management can achieve their prospectus forecasts. So the next company I'll be looking at is another recent IPO, and that is Clean Space Respirators. Their share price is down 21% over 2 days since they released their half-year report. So on the day they released it, the share price took a hit, and of course the next day the overall market was down. So sort of a double whammy for Clean Space. Share price is still above their low since IPO, which is $5.50. But if the share price does fall below that, that would be very bearish for this company. When you look at the market cap and compare it to some of the financials they released for this half year, it does look like it might be good value. So market cap of 447 million with revenue of 40 million and operating cash flow 21. So price to operating cash flow, which is one of my favorite metrics. In fact, I use enterprise value to operating cash flow. That's one of my favorite metrics. It does look like it could be good value if they keep this sort of momentum moving through the rest of the year, and that is going to be the problem for the company. And even management acknowledged that, because they released a statement in their outlook which says there are clear signs that the pandemic has shifted to a closing phase, and it is expected that second half numbers will be lower than first half numbers. So what does clean space respirators do? Well, I've just provided an image there just below that statement which shows you their products, and you can just see it's mostly face masks. So just the fact that you can see pictures of face masks there should be able to tell you that they've really benefited with the pandemic, and with the pandemic coming to an end, they're not going to see that momentum continuing, and the management acknowledged that. So the third company I'll be looking at is ServiceStream. Now, this is a company I've already looked at before, particularly because the share price was in a nice little uptrend through much of last year, or the second half of last year. Anyway, share price got to $2.40, and then something really spooked the market. They released an announcement in regards to NBN. I can't remember right now what it was about, but it really spooked the market, and the share price went from $2.40 all the way to $1.80. And I do know some people who were stating that you should be backing up your truck and buying all in ServiceStream, but I believe that this was the market giving us some sort of clues that there was something wrong with the ServiceStream. So the share price from those two big down days, just going sideways or maybe slightly down, but still there was no change in sentiment. There was no uptrend in the share price. So there was no reason to be buying into ServiceStream. And even if I was a shareholder before those two big down days in December, I probably would have sold out, because the market again was giving us a clue. And those clues, or that clue, played out when ServiceStream released their half-yearly report on Thursday of last week. And we've seen the share price go down 33% in response. Now, a little snippet on the right there from just looking at their revenue growth or lack of growth over the past about 4 years or so. So it goes back to first half 2017. So this is half-yearly revenue. And we actually do see some good growth from the first half of 2017 to the second half of 2019. It's gone from 240 million to 504 million. But ever since then, it's been going backwards. And I always look at revenue growth for a company. It's the main thing I look for, because if you don't have revenue growth, in fact, if revenue is going backwards, the only way you can grow profits and operating cash flow is by decreasing costs. And by decreasing costs, you're actually limiting the growth of your company, and more than likely that's going to affect revenue in the future. And there's only so much you can decrease your cost by. So I always like to see revenue growing for a company, and we haven't seen that for ServiceStream over the last few years. So that's another reason why I've stayed out of this company. But I will be putting this on my turnaround watch list. So what I'll be doing is I'll be waiting to see how low the share price does go. And if I do see a shift in sentiment or a change in the trend of the share price, that could be a signal to buy into ServiceStream. But I won't be buying before then, because at the moment you could be just buying a catching, or not a catching knife, you could just be buying a falling knife. So the fourth company I'll be looking at is NRW Holdings. Ticker code is NWH. This is not a company I've been following closely at all. That it would be a lie. The only reason I did have it on my watch list was because the share price went from $2 all the way up to $3. So there was a nice little uptrend there. But over the past month or so, it's gone back to $2. Now, the share price was under a little bit of pressure just before the release of the half-yearly report. As you can see, the share price went from a high of $3.20 to $2.60, and then the share price has gone down 28% since they released this report. Now, I did go to Hot Copper to get a feel on the sentiment of shareholders, and there was a bit of confusion there, because a lot of the initial impressions from the shareholders was that this report was good, and they were confused why the share price was going down a lot. Now, I looked at the earnings per share, and the earnings per share went from 8.8 cents to 6.8 cents. So a pretty big decrease in the earnings per share. So even though the revenue actually increased by quite a bit, something like 300 300 million or so, the costs of the company just ballooned, and that's why the profits actually went backwards, even though the revenue went up. So quite a bit of margin pressure, it seems like, in the business, and that's why the profits went down, earnings per share went down. So even though there were some confused shareholders, it makes sense why the share price of NRW Holdings went down, simply because profits and earnings per share went down by quite a bit. And the last company I'll be looking at is KGAN. This is a company I've owned and sold so many times in the past that I've lost count. And the share price is quite volatile, so you can make quite a bit of money just selling on that volatility. They were a major beneficiary of the COVID-19 pandemic, as online spending has been brought forward 4 or 5 years. It was always going to happen. Online spending was always going to increase, but that increase has just really accelerated during this time period. And I think it will still increase quite a bit over the next 5 years as we all go to more online tail spending. So KGAN was a beneficiary of that, and there's other potential participants in this sector that are popping their heads up right now on the ASX, quite a few that I'm going to have to do a little bit more research on. Now, some of their financial numbers look pretty good when you look at their growth rates, over 100% growth rates, but I think the market is expecting those growth rates to be significantly lower over the next year because of that bringing forward in the online spending, and because we're in the closing phase of the pandemic. I think there's going to be more people who are going to want to go out there and spend money at shopping malls and that sort of thing, and spend less money online. Revenue 414 million, and you might think it's pretty bad. The operating cash flow is negative 23 million, but when you dive a little bit deeper into the financial numbers, you'll see there is a massive increase in the inventory levels. I think they've doubled their inventory levels, and they're just planning for the future, or they're planning for more expansive spending online. That's why they've increased their inventory levels. They didn't provide any guidance. Now, it's not a bad thing or a good thing. I could argue either way. Sometimes I wish companies didn't give out guidance. Sometimes I wish they'll give more guidance. So that's neither negative or positive. They did give us some January 2021 unaudited accounts, which does show fairly good growth since January of 2020, but that should be expected. So this is definitely a company I'll be keeping a very close eye on. Right now, the share price is under significant pressure. It's gone from $22 all the way to $14 in just on a month. And if I see any sort of change in sentiment and a change in the shift of the share price to an uptrend, I would be a definite buyer in KGAN. So that's all I got in this video of 5 villains from the February ASX reporting month. If you have any questions on any of these companies, make sure you leave a comment, and I'll eventually answer any comments you do leave, but it might take a while. Now, I'm not a financial advisor, so if you do need to seek any sort of financial advice for your own needs, make sure you seek out someone who is qualified and can speak to your own financial needs. That's all for this video. Have a good day. See you later. Bye.